Happy Friday, everybody. Welcome to another edition of Real Assets Weekly. Today's the 19th edition. It's Friday, November 3rd, and with us, no one else on the planet I'd rather talk to right now, Ryan Cobb. We've got some interesting acquisitions in the global supermajor energy space, and we can talk to a real life landman down there in the Permian. He's going to tell us some tales of boots on the ground and what's going on in his world. So, Ryan, how are you?
Hey, I'm good. Turtle, how are you, bro?
Good, man. Hopefully you brought some presents like last time. Last time we talked was, I believe, mid-June. We talked about Blackstone Minerals, and stock's been ripping despite just about everything else. So excited to
Yeah,
get
man.
into it with you. And yeah, I mean, I think one place to start. I just as your one of your favorite your Instagram is one of my favorite places to start uh today. I mean, I think this guy, Ryan Cobb, ladies and gentlemen, lives a very interesting life. And I think there's more to life than stocks and bonds. This man, he hears about a swell, he comes to the West Coast and surfs trestles. He hears about mysterious creatures in the Texas wilderness and he goes and gets them. What is this thing?
That is a cyca deer. Um, Honestly, I had to do a little research on it myself. It's a um, yeah, like I was telling you off air. I've got a place up in the hill country here, and you know, um, there's been a lot of exotic game ranches that people have set up there, and a lot of these animals have escaped, but the terrain is really like kind of rocky and craggly, almost like a less elevated version of New Mexico or something. So, you know, these animals actually do pretty well there. They've kind of established their own sort of, you know, return to the wild out there. Um, that being said, uh, your likelihood of hunting them and finding them when you're actually out there is pretty low. So, for something like that to happen, especially for a good friend of mine who doesn't make it out there much, was really pretty neat. And like you said, life's like layers of an onion. Most of the time I'm here in the office, but I try to get out and you know try to live an interesting life if I can.
That's a African species of deer, like originally.
I think it's like Eastern Asia or something like that.
Yeah, I think it's
There's
wild.
actually a couple varieties of it. It almost looks like a miniature red stag. It was a big animal, but you can't see it here. It's got these little sawed off legs on it. It's like a stumpy little critter. But I don't know. I kind of look at it like you ever seen the Lord of the Rings, like the dwarf king? He's like
Yeah.
he's not, compared to the elf and the man, it's kind of a little bit of a sawed off little shrimp, but he's kind of a badass in his own right. You know what I mean? That's kind
Yeah.
of this guy's role out there. He's the
Yeah.
he's the he's the dwarf king.
Wild. That is a wild.
best
That is pretty
best
wild.
analogy I got.
Yeah. Yeah. Speaking of wild, let's start here. I mean, really, we got to pay respects to to the man's last present, last call, or call or just really presentation. I mean, I went back and listened to our last conversation, and really wasn't so much it wasn't so much, uh, really endorsing any stock necessarily, except for it was just, here's a really interesting idiosyncratic setup. We have something that is very, very unique risk profile, right? There's not really any debt on the stock. It's a royalty play, so it's different than investing in like an integrated energy company, and and you have and it's exposed to energy, natural gas and
Hmm.
oil, which we're all kind of short. And that's how you laid it out. And sure enough, hell, man, it's worked out pretty good since you were last on. I don't know. So yeah, maybe just start here. I mean, what do you have to say for yourself? That was quite the call. You called your shot.
Hey,
You
well,
know.
thanks. I don't want to do too much self backpatting, but it does speaks to the process because what we were if I recall, kind of what we were saying was we were trying to give a backdrop to the sort of macro energy environment, which is not easy to do. You have to consider a lot of factors, and um, one thing we'd hit on was the sort of you know the sort of interplay between rates and oil, which are sort of unlikely bedfellows at most times. And, you know, I think, one thing we were pointing out was that the market had sort of been ripping. I know the Qs had been ripping at that time. And, we were saying, hey, like everybody's partying like it's 1999 over here. But, this looks more like a pullback in the inflation trade than it does a reversal of the trend. And, um, that was something we pretty much, me and you, without pounding the table, telling somebody what to do, we made a pretty damn good call about um, not only the correlation between the two, but what was going to happen if people got caught off sides thinking the trade was dead. And sure enough, man, what was oil ripped like $15-16 out of that consolidation on that last round. And that's the cool thing about what we do with Swami is that we give you a universe of names, and within there's high leverage opportunities. Like Blackstone is not the highest leverage way to play it's more of that. It's trying to give you a longer duration name to integrate into your portfolio that can withstand the volatility of a market like this. So from a trading perspective, um, we're long other names, and some of them, had some really good moves off that, off that little consolidation pattern rip we got there. But Blackstone has continued its ascent. I was kind of going over their last quarter numbers here. I'll keep it real brief, but they're maintained 125% distribution coverage. It looks like they've socked away some extra cash. They've basically outperformed every quarter. The last quarter, the market didn't really like it, but from where their guidance has been to their actual performance has been pretty stellar. And now I see they've putting away some cash, and they're going to deploy it to buy back, units that they feel are undervalued, which is always something you like to see management do. And they kind of outlined a strategy of trying to buy back the preferred convertible units, which I'll try to dig a little bit more into, maybe shed some more light on that next time around. I don't want to get stuck talking, too deep about that when I'm not entirely sure, but go ahead.
No, yeah. Quick question on BSM before we move on is so one thing in the Swami scores, we'll pull them up a little bit, but you've kind of seen lately the natural gas scores or the more gassy names have been sticking to a slightly higher score than the more oily names. The majors, maybe because of the acquisitions, have not had super strong Swami scores. And so, but what I was going to ask you is back to the 125% distribution coverage. That is because natural gas has been strong as of late, but it clearly had a very rough start to 2023. That hedge is kind of what kept them in the game with being able to cover that distribution. Is that they have like a big natural gas hedge or something like that? Is that?
Yeah, no, that's correct. They are a pretty big proponent of hedging, and like it probably cost you like if we're talking about that big run up we had prior to the winter of 2022, it limits your upside sometimes. But when you have a big mean reverting move like that in natural gas, it can help you out too. And I think their management is pretty smart, and this isn't really a name you buy for leverage. It's a name you buy for a full cycle position. And you want them to be able to be stable with the distribution. And that's something that uh, it's sitting at like 10.5% annualized. Um, when you got that kind of margin of safety built into a name, uh, you know, to me, that's the kind of position I'm comfortable sort of autopiloting around, as opposed to the incremental active management you have with other names. So
Right.
uh kind of
Makes
you hug your pillow at night and you sleep good.
and that makes a lot of sense. No, it really does.
Yeah.
Um, so let's get into you made some slides for us today. We really really appreciate that. Let's get into the meat and potatoes of today's conversation. What's going on, man? All these super majors just need Permian assets.
Yeah.
What and how and why do they, or if you have any insight onto like kind of the motivation and like why at the same time, and the floor is yours.
Well, yeah, it's pretty it's pretty interesting watching what's happening right now.
Start with some charts, maybe.
Um yeah, let me just kind of hit on the bigger picture with oil right now so that way I can
Yeah.
kind of tie in what I'm thinking about these mergers here. I will start with the caveat that I am really not sure of why the timing is the way it is with this. I think I think everybody would have preferred to make these moves coming out of COVID, when everything was bargain basement. But I think a lot of it is, despite how smart management is and despite how smart or just orthodox the concept of buying low and selling high is, there was a lot of intrepidation in this market coming out of COVID and a lot of uncertainty with regulatory issues and geopolitical issues. Still is. And I think a lot of these companies probably see a more stable path here. So even though they're buying it at kind of elevated prices, um, I think they probably they're human like all of us. We were all, let's be honest, maybe we were dabbling in oil and gas stocks coming out of things, but you know, a generational low like that shakes out a lot of money, and
Yeah.
it's pretty scary to try to dip your toes back into a market like that. So
Yeah.
I think this is the calm after the storm. This is a probably a more stable investment environment, and it does make a lot of sense. So I'll touch on kind of what I'm seeing in the overall crude market. Obviously with the Israel Palestine conflict, a lot of people are watching that. We had a big, a reasonable pullback after that big run up that me and you were discussing, and a lot of that I think is the geopolitical premium coming out of it. Um, there's always sort of a knee jerk reaction to conflict in the Middle East. And obviously it does jeopardize supply. I think the biggest question, and this still remains, which makes me wonder if the market is, you know, completely discounting this, is what is Iran's role in this, and what exactly was Iran position with Hamas in terms of green lighting and funding something like this, and I really don't want to get into the weeds on, the fog of war here, because we may never know the true answer to this, but, um, you know, there's a lot of speculation, especially considering that Israel and Saudi Arabia were sort of on the brink of normalizing relations between those two countries, which is massively negative for Iran. And,
Yeah.
within that context and the timing of it, I think it's safe to wonder what role Iran played here and what possible repercussions would be, because even though Iran is technically still under sanctions, they're funneling a ton of oil to China. Like, I'd be surprised if they're not producing and selling on the black market the amount of oil that we sort of bake into the cake as um, what we're in deficit for from world supply. So when you kind of have that gray area and you think about what an absolute wipeout of their market share would be, it represents a big time upside tail risk to oil prices. That's not the way I see this. I see the geopolitical situation as just being very murky, and something that the the tail risk to me is to the upside, not the downside. So that said, if things normalize and Saudi Arabia can kind of come out looking like the hero for negotiating a de-escalation here, and maybe the ask is that they put barrels back on the market in order to, ease some inflationary pressures against other countries, us namely, then that's a likely, outcome, which probably takes us lower in crude prices. In general, I don't focus on things I don't understand or control. So I'm cognizant of cognizant of what's happening here, but I try to focus on US production because that's kind of where, what I understand and what I can model. And we actually hit all-time high over 13,000 million barrels a day in this country here on the recent EIA report. And, I think that's very interesting considering all this M&A activity going on, because to me that doesn't seem sustainable, because, I think when we get into the M&A slides, I can kind of shed a little bit more light on why I think it's US production is probably in the process of peaking. So yeah, we can go ahead and jump into those if you want.
Yeah, no, that'd be great. Yeah, a couple that'd be great. Let's get into these slides. They look they look very interesting. I think, like you said, I really
Yeah.
am a fan of just plotting. I just think, pictures, so many words. And so this is cool, man. This is really interesting. Tell me more. What's going on? Not a lot of
Okay. So
oil in Oregon and Washington. Didn't realize that.
yeah,
Like none.
yeah.
How interesting.
Surprise, surprise. All the
Yeah,
the one outlier would be the golden state of California, which I know is dear
that's
and dear
right.
to your heart.
That's right.
Um, but anyway, yeah. So this is just permits over the past we'll call it 4 years, 4.5 years. So before you can drill a well, you got to file a permit with the regulatory agency. The red would be gas dedicated wells. The green would be oil. The olivish color would be kind of oil and gas. To be clear, most wells do produce a combination of oil and gas. So this does not give you a true picture of what natural gas production is like in this country and where it comes from, because it's an associated product of almost all wells. But, you do have certain basins and portions of formations that produce nothing but dry gas. So, just kind of looking at the overall lower 48 in Canada, it looks like I cut Alaska out of here. We just kind of see that activity's certainly picked up big time, coming out of 19 and 20. You can see, I mean, the COVID era is pretty obvious on the permit chart there. And so it makes sense that, US production is reaching all-time highs again. I mean, that's a pretty big increase in drilling activity there. Yeah, so that's pretty simple, it's a straightforward kind of visual aid. If we go to this next slide, this one's kind of difficult to understand, but maybe I can give some context to it. So if you can see the kind of opaque colored stuff there, and these are all the major basins. I couldn't capture them in one picture. So, from
Sure.
left to right up at the top, that's the Powder River, the DJ in Colorado and North Dakota. Below that would be kind of like Appalachia, the Marcellus, all that.
Yeah.
And then Texas is the big one. And so all the kind of opaque coloring is what we call units. So once a well is drilled, they establish a unit around it, which dedicates X amount of acreage to that well. Why that's important is once that initial well's drilled, that entire block of acreage is typically held by production, meaning there's not an impetus for an operator to drill a well, and like they're not going to lose the lease or the ability to continue drilling. Now, like in instances where the economics are good, you'll see a bunch of wells, drilled into those units, but in general, they're not forced to do that. So what I'm also showing here, you can see the kind of bright pink kind of
Yeah.
splotched around the fringes of this. So that's leasing activity within the past year. And so, just quick recap, leasing refers to typically exploration for new areas that are potentially productive. And what jumps out at me about these slides is that the leasing is all taking place on the fringe of these basins. That's because everything that all the low hanging fruit and everything that's good in these basins has been had and is part of a unit, meaning it does not have to be drilled. And two, or B, depending on did I go with one or did I go with A? I think it was
Forgot, but yeah,
eh,
proceed.
we'll call it 1B or
Okay.
2B. So
Yeah. There you go.
2B would be just the fact that most of the major basins have been found. And so when you look at this leasing activity, this only represents like incremental marginal locations that are remaining in the US. And it's not to say that there can't be new discoveries and new techniques that open up new discoveries, but for the most part, this big revolution of the shale plays has been had, we'll say. They're not the discovery portion of this is over. The manufacturing and optimization of drilling portion is now underway, which explains a lot of the M&A activity.
Totally.
And so when you think about what that means for supply terms and just the overall macro environment for oil, that's where it kind of gets interesting, right? Because if you have a bunch of known rock that does not have to be developed on a specific time frame, and a bunch of new leasing where there's a shot clock on that, but the production's not as good. Well, one, you need stable and higher oil prices, and two, you need you need a lot of activity to keep the treadmill going in terms of US production. So with a lot of this consolidation happening, to me that points to lower US productivity over the next 10, 12 years. And I think really considering the supply side of the market, even if that's a million barrels a day or anywhere from a million to 3 million barrels a day, that's a pretty significant amount of supply that needs to be maintained in order to meet demand. So I think it's a pretty supportive environment overall if you're talking about it from that perspective. Cycle down to that next slide if you want.
Yeah, no, that makes a lot of sense. And maybe I'll piggyback off 2 points I thought were really interesting. One is a quote from Scott Sheffield, the CEO of Pioneer. Saw him on like a Bloomberg thing about the merger, and he said, "Shale companies cannot survive on their own long term." That was the and so to your point, it's like then they, I guess, implying that they need to be, joined by integrated, majors like the guys that did the acquiring. And then one other quick
Sure.
point, you mentioned risk being to the upside, and in my head, I just had to go back to this chart real quick of natural gas from last year, and it's just funny how the market just kind of gets amnesia to issues that were big issues just not long ago, and Europe was going to freeze and this and that, and now, we're on to the next narrative. But the point is just as far as risk being to the upside, I thought that chart does a good job of, your Apple earnings are unlikely to to go from 250 to $10 in a couple of months.
Yeah, that's why. Yeah, the leverage is on your side here, and that's always a good place to be, even if it's not, obviously you don't want to put all your eggs in one basket, but you kind of go back to the soccer analogy. I think we talked about this one time, maybe you play defensive here, considering the entire macro environment, but then you kind of have your strikers that sort of push forward and try to counterattack, and that's sort of what you get when you have a leverage profile like, natural gas oriented companies. So I think it's pretty interesting.
Yeah. So tell me a little more. What's interesting about this slide?
Oh, okay. So I was just kind of wanted to go back to the couple, the major acquisitions we've seen here being Exxon, Pioneer, and Chevron and Hess. So this is the Texas portion of it. What I think is pretty interesting is like these guys sort of, it's kind of keeping up with the Joneses between those two. They're the two kind of bellwethers in this industry. And I guess the one thing Chevron was kind of lacking that Exxon, had was this bigger exposure to more shale basins and also to deep water Gulf of Mexico. And one thing that's not pictured here is Guyana, which is going to be a big source of supply going forward. And that's kind of like the crown jewel. In my opinion, Chevron bought Hess, specifically to get access to Guyana. I'm not sure exactly how to say that. But again, I don't deal with anything in Guyana or the Middle East. So I deal with the U.S. And yeah, what I'm looking at here is, some pretty good incremental exposure for Chevron to the Gulf of Mexico, almost no exposure to the Midland Basin or the Eagle Ford or Haynesville through the acquisition of Hess. They really don't have a position there. Vice versa, Exxon acquires half of the Midland Basin, if not more, which is kind of what Pioneer's made its name on. And it's kind of interesting to see the two companies, like Exxon is purely acquiring a shale basin and Chevron's acquiring this accumulation of assets, spread out pretty far and wide. So pretty interesting to see. Just going down to this next slide. Looks like I cut off a little bit of data here, but this is just this is all the different four operators and where they were drilling, and kind of how the wells performed over the first 12 months. It looks like it cut off some of what I was saying here, but Hess's Gulf of Mexico assets were the best from a pure daily production standpoint, and then you can kind of see over the vintage years, who performed which way.
Maybe is this the slide you're is this better, or you want to go back to the last
one? Well, I think I cut off some of the data on this one. I'll redo it for everybody when we send this deck out, but we can just parse through this. This isn't, too important. It's just kind of a cool visual aid of by year who was, drilling what. And we'll expound on that a little bit more on this next slide. This is sort of Chevron's acquisition of Hess, more or less. Exxon's already had a legacy position in the Bakken. The Bakken is still going and it's still a good asset. It just it's not as it's sort of overlooked compared to others, but it'd be interesting to see what Chevron has in mind. Chevron and Exxon both have a ton of expertise in like what we call like secondary or tertiary recovery methods, basically engineering like different ways to squeeze incremental oil and gas out of fields that have already been drilled. So that might be the next big phase going forward. Um, I'll just leave it at that because I don't really, it hasn't really come out much about how they're going to do that. Um, I could really get in the weeds if I want to talk about refracts and things like that, but they haven't really proven to be commercial. But I'd have to
Is
think
that
these
like
companies have some kind of long term.
right? Sorry to jump in there. That's kind of like these injection sites that you reference here in the first slide, or is
Oh,
that
yeah,
injection is
yeah.
one
So
form of it?
there's different ways to do it in more conventional reservoirs. Maybe they'll do like a water flood where they actually pump water into the reservoir and sweep the remaining reserves out. Sometimes they do it with CO2. Um, with shale, you have really tight rock or what we call like lack of permeability and porosity in the rocks. So um, a refract kind of refers to going back in and fracking segments of the well that weren't produced along the way. Um, I'm just going to throw this number out there. I don't know if it's correct, and it definitely doesn't apply to every basin and every rock, but the order of recovery from a lot of these wells is like under 20% most of the time. So meaning if I drill an Eagleford well or a Bakken well, I'm only recovering probably 14 to 16% of the reserves in place. So, there's a lot of upside to trying to figure out how to capture those reserves that are already there. And
Right.
it's kind of what I'm getting at is like, I think these are the two companies that are going to spearhead something like that.
That makes sense. That totally makes sense. So it's like, yeah, so maybe to summarize, like, especially for the, non-specialist viewers, like the Exxon and Pioneer deal, like to sum it up in 2 words, it'd be like Permian tech, and maybe a third. Okay, actually, I would probably stop there, and then Chevron and Hess, you would say Guyana tech. Is that what do you think about that
Yeah,
summary?
I think that's a pretty good way to look at it. I mean, obviously, Chevron's getting a mixed bag of good assets, but I think that they pulled the trigger on that deal specifically because of Guyana. Um, so you know, it it augments and enhances both of these guys' portfolios in a pretty significant way. Um, and both these deals were consummated at maybe like a 10 to 12% premium on both of the other companies' stock price. So to be honest, they got a pretty good deal. And I think me and you were both remarking about how crazy it was that Exxon didn't even use any underwriters or analysts. They just sat down in a room, him and Scott Sheffield, and basically made a handshake deal.
That's awesome, dude.
Uh,
That makes
yeah, that
me
is awesome.
want to join the oil patch. Um,
That
well,
never happens anymore.
let me throw a curveball to you. Well, actually, this is a great deck, dude. I really appreciate your. I don't
Cool.
understand all this means. I don't really know what this means exactly.
Yeah,
Maybe
this is
let's
just
do
kind
one
of
slide. Yeah,
focusing on
yeah.
Pioneer and Exxon. I'll run through this pretty quick because
Yeah.
maybe go back up to that one slide. So you
Yeah.
can
This one.
see Pioneer in yellow here. Yeah, you can see just how much of the. Oh, sorry, one more up. Just you can see just how much of the Midland Basin Pioneer actually had, and
Right.
so it's a pretty concentrated interest. But it centers with a lot of what Exxon had, and there's just a lot of synergies involved in something like this for Exxon. It makes a lot of sense. And we skip one more slide down. This is Exxon, Chevron, and Pioneer's kind of profile of one more down, buddy. There you go. Good deal. Um, it's a lot to look at, but basically what this is these are all the different intervals in both the Delaware and Midland basins that have been drilled by these three companies. And you can really see why the Permian is such a prized possession because, I mean, in some instances, you may have 4 to 7 benches of productive layers in this thing, you know, and that's pretty unique. The other basins don't have that type of um, optionality to them. And I think another reason why this took so long to happen was because these companies wanted to get comfortable with the fact that these different intervals can actually be productive, and they really had to study how they interact with the other wells that have been drilled in different target formations, you know, because you kind of run into the problem of, is this just reserve acceleration when you're producing this, or is this actually incremental reserves that exist there? And you know, when you're drilling $11 million wells, you want to make sure that those $11 million wells have a you want to make sure they have a like a economic profile to them, and they're not just incrementally forcing reserves out of other um, wells. You know, and again, try not to get into the weeds there, but it is a pretty important thing to understand, you know, because if all you're doing is accelerating your returns at a high cost of capital, well, that's not really financially viable in the long run. And that was like the biggest question that had to be answered out there. And I think these two deals sort of speak to um, the actual just total economic value of the Permian, you know, and you know, it's sort of the one basin that we have left in this country that's we can't really quantify and know what it can contribute to U.S. production going forward. So it's that is kind of the thing to watch, and I think Exxon just sort of crystallized that for us all.
That's awesome, dude. Great presentation. Thanks for coming out. Like, I got a closing question for you. Put you on the spot.
Sure.
No, not investment advice. Who is not investment advice? Who's Oxy buying? Like what? That that's the
Oh,
that
okay. I threw this in there for you because I saw your Warren Buffett jet
yeah.
tracer.
Yeah, here you go. Yeah, exactly.
Oh man.
Shout out Aubrey K on Twitter. Threw out
Yeah.
the jet tracer, which is you just can't get away with anything in this day and age, man.
Yeah. Oh,
But
you
yeah,
know what?
any yeah, go ahead.
I left a slide off this presentation which showed just how many oil companies there are in the Permian. I have to infuse
Yeah,
that back in here for everybody, but that was the
yeah,
point of this slide, is that, you know, there's not a ton of big ones left to buy, but the Permian in general has a ton of companies that are acquisition targets. And here's the two big ones I'm watching. You know, these are the kind of the mini majors that are left standing after the Exxon and Chevron deals would be Occidental and EOG. EOG is notorious for not, they've never grown through acquisition. They are pretty much strictly they're a very good like finder of oil. You know, a lot of their stuff is just organic exploration. Um, so I really don't expect to see them deviate from that. But Oxy's got to be shopping here. Um, just kind of based on their position. Um, I kind of maybe see them maybe going after a couple smaller companies. Um, maybe like a Centennial Resource Development, CDEV, CDEV would be the ticker. It's sort of you know, it'd be a good fit for their Delaware Basin stuff there in Reeves County. Um, or, you know, the really interesting thing would be like a tie-up of EOG's Permian assets with Occidental, which is why I put this slide together, because you can see just how well they fit. And EOG sort of has the premium drilling formula, you know, so um, nobody's really been able to catch up to them in terms of you know, their ability to produce this stuff. So um,
Oh God, Ryan, you're
that would
moving this.
be a big
Look at
that
this.
would
You're our live viewers must be buying with two hands. Look at this volume bar on CDEF.
what
Oh wait, that's That's something else. That must be something else. Wait, nothing Israeli
He's getting
stock.
ahead of it.
What
Sell,
is
Mortimer, sell.
what is the is it Centennial is what is
Yeah, CDEB is the ticker.
oh CDEV. Yeah, yeah, whatever. All right, yeah. Just kidding, not us. We're not moving stocks.
Oh man,
STC, don't worry about us.
got me
Uh
excited.
yeah, dude. That was all everything you ever want. Well, that was a lot of good stuff, man. I really appreciate your
Trying to
time.
pack it in there for you, man.
Dude,
I love to sit here and talk my book up, and especially my CDEV options position here. But
if you divide alpha by number of followers and amount of time, man, we are really exponential alpha here at Swami Research. So with that, we appreciate you. If you want the deck, email us at info@swamiresearch.com and we'll send you out a copy. If you need landman services or anywhere in South Texas, especially Pescadero Land Management, Ryan Cobb is the man. That's the dude right there. So with that, have a
thank you
great
for the
day,
plug, my friend.
and we'll be back. We'll be back soon on Real Assets Weekly, and see you guys on Twitter. What do you got? Any closing
All
comments
right.
for the people here, Ryan?
Well, just know out there, guys, that those are not fake studio laughs. Turtle was actually that funny, and always have a good time doing this.
Yeah,
So,
for sure, man.
thank you for having me on, brother, and we'll do it again here before long. I'm glad we
Hell
could do
yeah.
it.
The live Real Assets Weekly from South Texas coming either Q4 or Q1, but it's coming. I think Q4. I think we can do this. Maybe Q1. Maybe Q1. Talk soon. Have a great day, and thanks for.
All right, buddy. All right. See you, bud.